Have you ever wondered what it takes to break into the closed-off world of venture capital? Well, we're going to pull back the curtain today by following the incredible story of Anna, an outsider who managed to climb all the way to the top of a major Silicon Valley firm. Her journey tells us pretty much everything we need to know about how high-stakes tech investing really works. So this is Anna, and her story doesn't start where you'd expect, like at Goldman Sachs or something. Nope, it starts in Spain. She had a background in business and law, and she freely admits that growing up, she didn't even know what venture capital was. But her path from there was just this incredibly rapid, deliberate series of moves. I mean, think about it. In less than a decade, she goes from law school in Spain to working at Amazon, getting an MBA from Stanford, founding her own Y Combinator-backed company, and then landing a partner role at a VC firm. Each step was a calculated leap, getting her closer and closer to the heart of the tech world. Okay, so the first real turning point for her wasn't a job. It was a change in scenery, and more importantly, a huge change in her mindset. And that all happened the moment she set foot on the Stanford University campus. You know, the biggest lesson from Stanford wasn't something she learned in a lecture hall. Anna said the real value was seeing these legendary founders and VCs, people you see on the cover of magazines, just walking around being normal people in her classes. It completely demystified the whole idea of success and, just blew the ceiling off what she thought was possible for herself. That right there is the power of your environment. So after Stanford, Anna did what so many there do. She founded her own company. And she actually took investment from a firm called NFX. A few years later, in a cool twist, she joined them on the other side of the table. This story gives us the perfect way to really get inside the machine and understand how the business of venture capital actually works. At its core, a VC firm is a business, plain and simple. The partners go out and raise a giant pool of money from their own investors. We call them limited partners, or LPs, and their one job is to take that money and place bets on the next wave of super risky but potentially world-changing startups. And the work itself? You can really break it down into these four main jobs. First, you gotta raise the fund. Second, you invest that money in a portfolio of promising startups. Third, and this is a big one, you actively support those companies to help them grow. And finally, number 4, you exit those investments, hopefully for a massive return. The crazy part is this whole cycle can take 10 years, sometimes even longer, to play out. But here is the secret sauce. This is what makes venture capital totally different from, say, investing in the stock market. It doesn't run on averages. It runs on a mathematical principle called the power law. And what that means is that a tiny, tiny number of your bets will be responsible for almost all of your returns. Yeah, pretty much everything in VC comes down to this number, 1 or 2. Out of a whole portfolio of maybe 50 startups, it's often just 1 or 2 absolute grand slams that generate nearly all the profit for the entire fund. So VCs are on this high-stakes hunt for home runs because a single massive win has to pay for all the other companies that fail, and then some. So to find those massive outliers, firms basically follow one of 2 playbooks. You've got the concentrated strategy. You make fewer, bigger bets, trying to get a huge piece of ownership in each one. Or you've got the diversified approach. You make a lot more smaller bets, kind of spreading the risk around. Both are just different ways of playing the game, hoping to find that one company that returns 1,000 times their money. All right, let's stop talking theory and see how this works in the real world by looking at the specific playbook of NFX, Anna's firm. They're a team made up of former founders, which gives them a pretty unique angle on how to play this game. So NFX's strategy is this really interesting hybrid. They'll invest in about 70 companies per fund, which is on the larger size. But they make sure to take a meaningful ownership stake, so they're all in on helping out. And here's the key part. They keep almost half their fund in reserve just so they can double down, meaning reinvest even more money into their breakout winners as they grow. Their core belief, the thing that gives them their name, NFX, is the power of network effects. Just think about it. A social network like Instagram, or a marketplace like eBay. The more people who use it, the more valuable it becomes for every single person on the platform. It creates this powerful, self-reinforcing competitive advantage, a moat around the business. And NFX believes this one principle is behind almost all of the biggest success stories in tech. We're talking 80% of the value created. For them, it's not just a strategy they look for, it is the absolute foundation of their entire investment philosophy. Okay, so how do you actually spot the next billion-dollar idea before anybody else does? Well, the answer is totally counterintuitive, and it really gets to the core of what it means to be a great investor. So let me ask you, what do you think a great investment looks like when it's first being pitched inside a VC firm? You probably guess it's an idea that is so obviously brilliant that every single partner in the room immediately says, yes, we have to do this, right? Well, the reality is the exact opposite. According to Anna, when every partner agrees on a deal, they actually get nervous. And why is that? Because if an idea is that obvious, it means everyone else probably sees it too. And that means the market is already crowded, the price to invest is going to be sky high, and your potential return just shrinks. The real magic, where you find those massive fund-making returns, is to invest when an idea is contrarian, when most people think it's kind of crazy or just won't work. And then you have to be right as that idea slowly becomes the new consensus. This takes an insane amount of trust between the partners to back one person's weird, non-obvious bet. All right, now for the really actionable stuff. What does all this mean for you if you're a founder trying to raise money? When you walk into that room, what are investors like Anna truly looking for? It really boils down to a few critical things. They need a team that can both build a great product and sell it. They're looking for a founder with an insight so unique that it actually teaches them, the investors, something new. And of course, they need to see how you're going to build a defensible business. But the one thing that underpins everything else is raw speed. Your ability to move, learn, and iterate faster than anybody else in the market. Anna uses this brilliant little filter to figure out how important a startup's idea really is. She asks, is this a burning, hair-on-fire problem that your customer is desperate to solve first thing on Monday morning? Or is it a nice-to-have that they can just, push off to Thursday afternoon? VCs want to fund Monday problems. And you can actually think about it like this hierarchy of needs for a business customer. At the very top, the highest priority are products that help them make more money. Just below that are products that save them money. And at the bottom are products that just save them time. The closer your solution is to the top of this chart, the more likely it is that you're solving a true Monday problem. So to leave you with one final thought, this is the stark reality of the game that VCs are playing. It is an incredibly intense, competitive, global search for a tiny handful of companies that will go on to fundamentally change everything. Every single year, there are probably only 20 or so that really truly matter. The only question is, how do you become one of them?